You've got the first level of real resistance at 34.34. You've got absolute resistance just above 3,500. And my target, once we move back into a dominant period in which we see gold prices begin to accelerate, return to rally mode, I will expect it to take out the new brass ring, so to speak, which is just above 3,500. And so 3,600 is definitely achievable. We've had calls by certain banks for 4,000. I could see that maybe next year, but realize I am exceedingly conservative with my numbers. So if we hit 3,800, I would be happy with it. It would come in much above my estimates, but it wouldn't be out of the blue.
Gold prices have steadied following a dramatic surge to a record high, as signs of consolidation emerge from escalating concerns surrounding U.S. President Donald Trump's trade policies. After touching an all-time intraday peak of $3,500.05 per ounce on April 22nd, spot gold eased to $3,287.72 by Wednesday's close, a decline of 6.1% from its peak. Analysts note that the pace of the recent rally has been particularly striking. GaryWagner, editor of thegoldforecast.com, highlights the sharp trajectory of gold's rise, stating that gold has gained value faster than in previous bull runs. Despite the recent pullback, prices have found strong technical support at the $3,300 level, signaling resilience even in the face of short-term selling pressure. The price pullback coincided with signs of potential progress in U.S. trade negotiations, briefly dampening safe haven demand. Gold fell to a two-week low after National Economic Council Director Kevin Hassett suggested the Trump administration was advancing in its tariff discussions and expected positive developments soon. Prices dipped as much as 2.6% on the day, while optimism on Wall Street tempered risk-off sentiment. Still, market fundamentals remain robust. Wagner notes that if the market transitions from the current consolidation phase into a full correction, gold could retest the $3,200 level. Recent data from the World Gold Council underscores this view. According to the WGC, gold's rally has been primarily fueled by a surge in investment demand, as investors seek protection from the economic fallout of trade tariffs. In the first quarter of 2025, total gold investment flows soared by 170% year-on-year, reaching 552 metric tons, the highest quarterly since early 2022. The WGC report attributes the surge to growing fears that Trump's tariffs will suppress economic growth while pushing inflation higher in the United States. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
This goes back to October 2023. That's where my pointer is. If my pointer's showing up on screen, the crosshairs are. But you had gold at 2,000, and it ran from 2,000 up to 2,600 in a fairly short period of time. In other words, a net gain of $554 in 134 bars. And this, of course, is a daily chart. The rally that we had in June 2024 began at 2,450, I'll round up, and concluded at 2,900. So in terms of the net result, it gained 18%, but that was $455. The first rally was $554, a 27% move, and realizes gold gets more valued, higher in price. The dollar amount might go up, but the percentages are going to get diluted. So when we look at a 33.29% gain, which is from the middle of December last year up to just recently, it's a 33% gain over 86 bars, and this is so 86 trading days, but a net gain of $878. But I draw your attention to this white box here, which gives you the angle that we're looking at. So this is a 32% angle, and I'm simply measuring the low here to the high here, a 32% angle. Here, the angle is only 19%, and here the angle is about 26. So this rally is significant. It is more than significant in that we have seen gold gain more value in a shorter period of time relative to the other rallies that occurred as recently as middle of last year and the end of 2023 up to about April of last year. And that is significant. You can see how strong that gain is and compare it to other rallies. The performance has been stellar. Percent of this 33% gain, as we said, about 10% of that gain is directly attributable to dollar weakness. So that means that 20% of the 30% move had to do with market participants extremely active beginning in the middle of December to the all-time record peak. And this is based on a closing price. Of course, it would be much higher if we looked at that intraday high that breaks above 3,500, currently at $3,315. The lows that we have seen have come in at 3,282. We've been definitively range bound. After hitting the high on Tuesday, the 22nd, we sold off pretty harsh on Wednesday, but then became very, very consolidated in terms of the open and closing price. You can see the body size is getting smaller. That's the relationship between the open and closing price. Again, these are daily moves in gold. And what is significant is 3,300 has become a level of technical support that even though traders have moved it into the area, and let me show you what I mean. These tails, what we call the lower wick on a candlestick chart, is a differential between the real body, which is the open and close with the rectangle drawn around it, colored in red if it closes below the opening price, drawn in green if it closes above the opening price. And so you had smaller bodies, meaning the relationship between the open and closing price, but you had superlative support in that on 3 out of 5 trading days, traders really took gold tremendously lower to lows of around 3,280. And that includes today. That is today's daily low, 3,278. But yet it is now within a couple of ticks of the opening bid. It is a little bit lower. That's why the candlestick is red. You would expect after a parabolic move up, and this is certainly a textbook definition of parabolic, you would expect a correction that is rather strong, going at least to about 3,200. But yet it has held significantly strong, and technical support's at around 3,200, but we have seen real support at 3,300, which means that anytime the gold market gets hit with a lot of sell orders, there are enough traders that perceive these lows as value, as a market that is now oversold, and they bid it back up.
Bullion remains up 22% year-to-date after reaching a historic high above $3,500 per ounce last week, before retreating slightly. The rally has been fueled primarily by investors seeking safety in gold as escalating trade tensions under President Donald Trump's administration roiled global markets and raised concerns over a broader economic slowdown. Additional support has come from strong speculative demand in China and continued central bank purchases, reinforcing gold's upward momentum. As markets await further clarity, all eyes are on Friday's key U.S. jobs report, which is expected to provide insight into the early economic effects of Trump's aggressive trade stance. The data could shape expectations around interest rates and inflation, two critical factors for gold prices in the coming months. Speculation continues that prolonged trade conflict could catalyze gold prices to climb even higher, with some projections suggesting potential long-term targets as high as $6,000 per ounce. GaryWagner remains cautiously optimistic about gold's trajectory. Once gold resumes its upward trend, a move to $3,600 is very realistic, Wagner said. And given the tariffs' persistent economic uncertainty and delayed inflationary effects, even $4,000 by next year cannot be ruled out. Let's get back to the interview.
My new base is 3,300, and it's based upon really the recent activity. I'm looking at the body size here and here, meaning Thursday, and these are short-term targets, by the way, and Wednesday. You've had a slow succession to lower closes, but all of them have been above 3,300. So I would expect that at the point this changes from consolidation, if we get a correction, it's one thing. We'll probably see gold trade to about 3,200. However, because of the fundamentals in play, and specifically I'm addressing the tariffs and what that's going to do to our economy. We've just had some key numbers come out this week. We still have the non-farm payrolls report, which the estimates have really dwindled. And we had GDP come out. We've got the PCE come out. So we've got important reports coming out, and they're all alluding to the same thing. And that is that what tariffs have effectively done is contracted growth and contracted the economy, the real GDP in this country. The same goes for a lot of the European nations and globally. If the end goal with tariffs was to have an economic contraction, I would say that the administration was 100% successful in that endeavor. However, I don't believe that that was the ultimate goal, but that is the outcome right now. You've got certain markets, interest rates, as well as gold, that are not acting in a traditional sense because the anticipation with gold was that we would get some interest rate cuts this year by the Federal Reserve. Now, the Federal Reserve is still saying that their target is to cut rates by about a full percent, but we are already into the year. We've had no rate cuts, and the anticipated first rate cut of 25 basis points is not expected until June. So we really haven't seen the interest rate cuts that we had hoped for, yet we have seen gold barrel to these incredible all-time record highs, specifically above 3,400 here with this tail, meaning that gold last week opened at 34.34. It closed at 33.90. However, it traded to an intraday high above 3,500. That's why you've got the wick, but no real body in this area. So you've got the first level of real resistance at 34.34. You've got absolute resistance just above 3,500. And my target, once we move back into a dominant period in which we see gold prices begin to accelerate, return to rally mode, I will expect it to take out the new brass ring, so to speak, which is just above 3,500. And so 3,600 is definitely achievable. We've had calls by certain banks for 4,000. I could see that maybe next year, but realize I am exceedingly conservative with my numbers. So if we hit 3,800, I would be happy with it. It would come in much above my estimates, but it wouldn't be out of the blue. In other words, it would be an understandable move based upon the high level of uncertainty in terms of how the tariffs will reflect in higher prices or inflation further on down the road. And that's the key with tariffs. There's a huge lag there between when they're imposed and when the consumer sees it buying their goods.
Gold's recent cooldown follows a historic sprint to new highs. Yet the backdrop of economic fragility and unresolved trade disputes keeps investor appetite for the metal intact. While a temporary decline from peak levels has materialized, steady support near key price zones and robust investment inflows underscore the metal's enduring role as a defensive asset. Market watchers now await economic cues from employment and inflation data, which could validate current caution or reignite momentum. With macro pressures simmering and global uncertainty unresolved, gold remains a focal point in the evolving investment narrative. Is this brief correction a healthy pause in gold's upward journey, or the start of a broader recalibration? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.